For me, Bitcoin blockchain is in comparison to like a Model A car, okay? So the Model A car was great. It revolutionized everything. It brought people closer together. It changed what we thought of distance and all that. Do we still drive the Model A car? We like speed. We like sex. We like the whole aspect of driving around and feeling empowered with Bentleys and Mercedes and all the new stuff now, but we still use the internal combustion engine, blockchain.
Hello, welcome to episode 22 of The Bitcoin Game. I'm Rob Mitchell. In today's episode, you'll hear the Blockchain Tech Panel from the State of Digital Money Conference, which took place earlier this year in Los Angeles. I thought it was a very fun panel filled with many insights. You might say the panel was stacked a bit on the side of blockchain tech over Bitcoin, and Bitcoin maximalists, amongst others, may not agree with some of the points made. But hopefully, everyone can still appreciate hearing ideas and discussion from some of the brightest people in the field. Some interesting tidbits. It's Jeff Garzik, you'll hear yell "not true" from his seat in the audience, and Connie Galippi also speaks from the crowd. I was surprised to learn the source of inspiration for Medici, the blockchain-based stock exchange being pioneered by Overstock CEO Patrick Byrne. On the panel, you'll hear in order of appearance, moderator Alex Rosman, Senior Manager of Transactions and Business Analytics for Deloitte, Craig Sellers, Co-founder and CTO for Tether, Eric Benz, Vice President of Payments at BitReserve, Judd Begley, Director of Communications at Overstock.com, and Elise Colleen, Associate Venture Capital Investor at March Capital Partners. And now, here's Alex Rosman.
All right, so we're the last panel of the day. So I'm from the East Coast, from New York, so I'm already in cocktail hour about 3 hours ago. So we'll see how this goes. But we got a great panel. What I want to do is put all the concepts we heard today together and maybe demystify some of them and really get way more into the weeds on some of the areas. So the challenge of these types of panels and talks is who's in the audience. The risk is you're going to lose half the audience because they're bored, and then you lose the other half because they're lost. So we took kind of a middle path. We weighed the two, and we decided the only fair solution is to make sure no one leaves happy. So that's what this panel is about. So I wear a lot of hats. I'm an attorney. Deloitte does not. It's one of the big four. We don't provide legal services, so way to market me. But I was a CCO of a foreign currency exchange company, and there's a lot of similarities really between retail Forex when it first came out, because it was based on online trading platforms and what you see, for example, with Bitcoin. So I've watched the space. I was at the New York DFS hearings in January of 2014 and talked with the DFS quite a bit, and as well as the industry. So what I want to start with is McDonald's coffee. So everybody's heard about a woman who got spilled coffee on herself and got $5 million. And then lots of people must have ran out and became personal injury coffee burn lawyers and couldn't replicate the $5 million. My point is, let's really get under the covers and really understand a lot of these concepts. For example, we think libertarian ideals, this, that. Let's really talk about the future success of blockchain. And if you want to know about McDonald's coffee, buy me a drink after this and I'll tell you about it. But it had to do with punitive damages. That's why there was $5 million involved, not compensatory damages. So when we talk about blockchain, I'm going to first introduce the panel, but then we're going to talk about use cases. And we can really break down blockchain use cases, I think, in two broad categories. One is something to do with financial services, such as payments, exchanges, things of value. And the other category would be record keeping, whether it's your ID information, intellectual property rights, smart contracts, all the other kinds of use cases you've heard. And so we're going to discuss a lot of those use cases. I want to also cover mining, cybersecurity, and venture capital, some of the things that you heard from the other panels, and get further in depth. But without further ado, let me first introduce Craig Sellers. please introduce yourself and tell me about your company.
Sure. Hello, everyone. My name is Craig Sellers, and I am the co-founder and CTO of Tether, which actually digitizes cash and leverages the Bitcoin blockchain so that you can use dollars, euros, yen, and about 7 other currencies exactly like you use Bitcoin. Hold them in your wallets, put them into cold storage, leverage multi-sig, etc. I am also an omni-technologist and an advisor for Factom, Scenario, the MadeSafe Foundation, and Tau Chains.
Hi, I'm Eric Benz. I do all the global payments for BitReserve. BitReserve is a value engine, so we actually look at value in many different ways, and we are actually a economic layer that sits on top of the Bitcoin blockchain that provides free membership services. So when we say membership services, financial services, and the ability for any person, whether it's a bank, a clearinghouse, a credit union, a wallet company, an exchange, or a customer as a member to take advantage of all the other member benefits within our platform. So, creating a more egalitarian view, which is API driven. So we kind of hide everything, all the guts, all the complicated facets of blockchain, and really allow more of the everyday users, industries to take advantage of the services that we're providing them.
My name is Judd Bagley. I'm Director of Communications at Overstock.com, and we're the first major online retailer to accept Bitcoin. That happened happened in January of last year. Through that process, we've come to learn more about the nature of the blockchain and identified other business processes that can be made easier, through it. And in that respect, we've begun a project that we call Medici, dedicated to creating an alternate stock exchange that would be mediated by decentralized ledgers. So that, and we also have a little portion of the company. We're doing venture capital investments in companies that are building on top of the blockchain, not Bitcoin little b, but Bitcoin big B, Bitcoin 2.0. So kind of in the middle of this. And can I say how nice it is that every one of us has our own microphone? That never happens on these things. So whoever's choice that was, thumbs up.
I'm Elise Colleen. I'm an investor at March Capital, which is one of the larger venture capital firms here in Los Angeles. Previously, I invested with Future Perfect Ventures, a New York-based micro VC fund, and before that, Clearstone Venture Partners. So at March, we're focused on both enterprise and consumer technology, and specifically technologies that are applicable both in emerging and developed markets, and always take an international perspective to what we look at and invest in and who we partner with.
So I thought we would first start by demystifying or explaining what the definition is of blockchain. And how is blockchain separate than Bitcoin? In my opinion, in my view, blockchain simply means triple accounting ledger, right? Based on, so you've got a credit, a debit, and an electronic signature. And there's all these terms going around, such as centralized versus decentralized. So I thought we'd explore that aspect first before we got into side chains and some of the architecture of blockchain. Craig, what do you think when you hear the term decentralized or centralized as it applies to blockchain?
That's a loaded question. When you ask about decentralization versus centralization, what comes to mind for me is, well, let me take a step back. The concept of what is now being called Satoshi consensus is the innovation of the Bitcoin blockchain itself, which is there is some fact that a whole bunch of people care about. The question is do they care about it because someone said it was true, or because they were all able to agree that it was true? And the innovation of Satoshi consensus was, in fact, that you don't need a single individual or a single group saying that a fact is true. You've got an entire community of people that are working on the same logic and the same processes to agree upon that truth. So that's how I personally define decentralization versus centralization, is who is defining that truth.
And with that, does anybody else want to offer their opinions?
Well, I think I'll go ahead and do it, because it is really interesting that among the the Bitcoin community, there's a real tendency to get angry, and I'm talking about like the bloggers and on Reddit and things like that. There's a real tendency to get angry at anything that's being built on top of anything other than the blockchain proper. I think that's misplaced anxiety because anything that is open, that is transparent, and that is validated through algorithmic consensus, I think qualifies as there's no reason why that's centralized, in my opinion.
I guess I'm really low level, so just to separate things, when you're looking at something that's decentralized, so Bitcoin blockchain is decentralized, and we were having this conversation, but it might be decentralized in its format, but again, you can actually pinpoint and say, okay, well, there's blockchain, and in order for blockchain to run, you actually need these centralized services in order to do that. So again, it's a bit of a misnomer, to be honest with you, centralized versus decentralized, and I think that as we move forward, we're going to see an area to where that won't even be a question anymore. So it'll be decentralized services operating in a centralized manner. I mean, again, it's a misnomer, so I'm still trying to see how that plays out, but just giving it an example, like, you can see that that's where the blockchain is, and that's what needs to run it, and it's centralized, even though that is a decentralized service.
So I think that what's important in the centralized, decentralized, and distributed discussion is who holds power and who's running the network and signing off or committing transactions to the network. So when Satoshi wrote the white paper, he didn't reference decentralized networks. He uses the term distributed and only that term. And a distributed network would be a truly peer-to-peer network where we would all be using CPU or GPU power to prove or disprove transactions. And now we've moved to decentralized, which is kind of what exists in the traditional financial system, where there's many hubs that spokes come out of rather than one single central hub. And decentralized is a bit more vulnerable than distributed, right? And centralized is even more vulnerable. So the way I think about it is what's most resilient to attack, and that attack can come in the form of hackers looking for money, or it can come in the form of governments looking to regulate and impose restrictions. And this is why I favor distributed or decentralized networks versus something that looks more centralized.
Yeah, I think it's an important question because there's a lot of feelings, strong and anti, about these types of terms. So, for example, a lot of the community will say, "Oh, centralized. Well, that's a bad thing," or "Decentralized is a good thing," except when it comes to not having a central authority to pay back your money if something goes wrong. So, an example is, and they'll probably get mad at me for saying this. I don't think anyone from Ripple's here. But when I was speaking with Ripple, I said, well, regulators are going to love you because you have a centralized network, right? You can control the ins and outs, and you know who the banks are in the network. And Ripple corrected me and said, no, we're decentralized. And of course, they're decentralized, but yet they have a closed network. So there is no clear definition, and think about what it actually means. Or if you take a side chain, you've got a decentralized ledger, but you've got centralized functions in a side chain that are getting put into that.
When they work.
When they work.
Right.
So who has any thoughts on side chains, since we're talking about kind of types of issues of the blockchain? Anybody want to cover side chains?
I'll just go ahead and say there's no way this crypto revolution is going to happen on top of the Big B blockchain. There's no way. It's their technological constraints, the bloat. I mean, the things like 30 gigabytes. And at some point we have to. I mean, if this thing's going to reach mass adoption and applications in areas other than the currency, it will not happen on the blockchain. There's no way.
Yeah, I mean, you definitely won't see Visa plugging into Bitcoin blockchain. I mean, they do, 30,000 transactions a second, which is really small in comparison. Then you talk about high-frequency trading and all that. I mean, again, low level. For me, Bitcoin blockchain is in comparison to like a Model A car, okay? So the Model A car was great. It revolutionized everything. It brought people closer together. It changed what we thought of distance and all that. Do we still drive the Model A car? I mean, there's maybe a couple people that collect it and drive it around, but we like speed. We like sex. We like the whole aspect of driving around and feeling empowered with Bentleys and Mercedes and all the new stuff now, but we still use the internal combustion engine, blockchain. So blockchain empowering Bitcoin and blockchain empowering all these other different technologies out there, that's really what matters, and that's the underlying aspects of really what we're talking about. So the Bitcoin blockchain specifically is you know, it's been a successful pilot and a use case, and if it does decide to scale and do its thing, then fantastic. I'm not saying that it won't. I'm just saying that as far as the scalable solutions that industries and businesses will actually need moving forward, it doesn't provide them what they want.
You know, I would take that analogy a step further and point out that the Model T proved the concept of assembly line production, which has changed everything, you know. And I think that the same will, you know, one day we'll look back on Bitcoin and say that, but then we'll look at all these other applications and recognize it's a good deal. It's a good thing we didn't stick with that exclusively. So,
well, we're building on top of things inherently when it comes to the blockchain technology, and we talk about side chains as alleviating the problem of blockchain bloat. But eventually, you know, we're saying we've got a 30 gigabyte Bitcoin blockchain today. Well, in 4 years, we'll have a number of side chains, each 30 gigabytes in size. And you have a whole bunch of these distributed ledgers that are in fact continuing to grow in size from the beginning as small and with no upper bound. There's actually a cryptographic innovation that has not yet been invented, which is a means to actually have validated transactions that do not require full history in a way that is completely verifiable. That innovation has not been invented yet. And sidechains and a variety of other techniques and technologies are trying to alleviate the problem of the Bitcoin blockchain being this gigantic ledger over time. But the problem itself has not been solved.
While also taking advantage of something, so the difference between the Model T and the blockchain is that there's no network advantage to the Model T, right? So side chains, as Craig I think was referencing, or I'll tag on to say this, is that side chains does what Craig said, but also it provides the value to the side chains of the network effect created by Bitcoin mass adoption. So I would take a different perspective and say that absolutely it's going to be built on the backbone of blockchain for sure. And this is a result of the network effect created by adoption, and side chains is a brilliant way to leverage that.
So sidechains doesn't actually exist right now. I just wanted to highlight that it's not actually working. This has been a proposal. Well, the one peg, sure, but the two pegging, I don't. Again, there's a lot of. Thank you, Jeff. But again, I just wanted to highlight because that I have a personal feeling that there's a lot of economic flaws in the proposal of sidechains, so I would rather not comment on that. But you know, because I don't think the audience is really too technical on that. I just wanted to highlight that it's not actually going to, unless they fork the Bitcoin blockchain and break the blockchain. But then again, you know, what are you going to do?
Well, I see we're getting some good impassioned debate going. So I just want to carry it further, because before we talk about use cases and hear some of the business models today from the panelists, as well as a VC perspective from Elise, let's talk about regulations. Because we think we understand them, but do we really understand them? Let's talk about reality. Let's actually lift the covers and figure out what's going on in the US. So here's my 2-minute perspective on this, okay? So you've got Bitcoin. Bitcoins are being used to buy drugs over the United States Postal Service, right? Much easier to do than in an alleyway where you could get stabbed or, you know, your money stolen. So you're sitting there at home and you get a USPS drug shipment. And, you know, law enforcement starts complaining, this is embarrassing, this is awful, even though the Tor network, we know the originations of that. But like the Bin Laden thing too, right? Afghanistan. But so you've got this problem. The way that Congress works is it's reactive. It has to appease its constituency. It needs to show that it's tough on crime. So Congress says, FinCEN, you're our federal arm, you're our intelligence unit, our financial intelligence unit, that's where all the SAR reporting, everything goes, is to FinCEN. You need to do something about this. You need to create some kind of regulations so that we can enforce money laundering and terrorist financing regs. Because it's embarrassing that the US Postal Service is being used for Silk Road. So FinCEN's thinking about it, thinking, what are we going to do? What are we going to do? And then Mt. Gox hits. And you've got this massive, breach of kind of consumer protection. So all regulations, most of them, are either anti-money laundering or consumer protection. That's why you're going to see the Consumer Financial Protection Bureau will step in next, the CFPB. So you've got FinCEN now has the Mt. Gox problem, and if whoever was at Money 2020 last year heard Ben Losky say that he went to Japan, he said, why aren't you guys doing anything about it? And right away, the New York DFS started doing things, but FinCEN came out with the easiest solution they could find. And the quickest solution, instead of going through rulemaking and creating some new creature, which would take a long time, was just to stick it, pigeonhole it into the money transmission column. And there's like casinos, US Postal Service, and money transmission. And they created a legal fiction. The legal fiction is that if you have, at the time they called it virtual currency, that is convertible into real money, then we can regulate it as money transmission. And ever since then, they've been stuck in a rabbit hole to justify that legal fiction. It's a legal fiction because, take the IRS. IRS said this is a commodity, we're going to tax it based on its fair market value when you bought it to when you sold it, just like you do with any commodities or stocks, equities. So other governments are looking at it, but FinCEN is stuck with this convertible to real money definition. So is our Beanie Babies money transmission? Because the Beanie Baby market used to be big bucks, and you could convert your Beanie Baby into lots of money. And similarly, you can use that logic to almost anything. So that is a huge struggle that law firms are having right now. It's a huge struggle that venture capitalists are having right now, is that FinCEN says that if you do something with a cryptocurrency that's convertible into real money, and believe me, we're not in business not to have real money, then it's money transmission. Then it came out with some administrative guidance speaking about brokers and dealers. So if you're using your own Bitcoin as a company to exchange money to send somewhere else, you're still regulated. What's interesting is miners. Miners are not regulated, but some miners, and I'm not going to put words in anyone's mouth, but want to be regulated so that we can certify and have transparency. So number one, we're a federation. So we have a federal government and then state government. This whole 50-state treatment it's very burdensome. What it means is that if you're an entrepreneur and you want to test a new idea in the blockchain or Bitcoin market space, you're going to spend about $1 million just getting registered in 50 states and with FinCEN before you can even test your idea. Why is that? Because when you're a regulator of a state, you answer to your constituency. You don't want a Bernie Madoff issue. What happened was JP Morgan Chase, turns out, had a Bernie Madoff account, so they ended up paying $1 billion fine for that because they didn't file a SAR. So let's be honest, it's realpolitik, and it's the reality of what's going to happen with regulations. It's risk-based, but you're going to get in trouble if there's ever a big money launderer or terrorist financing on the other side, such as the news that ISIS is using Bitcoin. Connie?
I'm just curious what the other panelists might think.
Yeah. Well, so all I wanted to do is set that baseline. And with that, I want to hear about two kinds of use cases. One is the financial ones and understanding what regulation is, and the other is going to be the non-financial, the non-regulated, and which ones you want to go into.
Okay, I know from Tether's perspective, we can speak a lot to the FinCEN side, the registration side, the regulation side, the compliance side, and all of those pieces. But in general, I want to take, again, a step back and look at the blockchain technology as the machine you can't turn off. It's an agreed upon rule set that we're all using, and you can't turn it off. And its rules right now are agreed upon to do basically two things: to ensure that the sender had the right to send value to someone else, and that the recipient was exactly who the sender intended. That's the rule set that we're working off of right now. But that doesn't put any conditions on who can send what they have. You can set your own rules with multi-signature, et cetera, to say, you know, it would take two of us to agree to send. But technologically, I can do whatever I want to with that value that I hold. So the regulation piece is always on the fringes and on the borders. It's how do I get into the system and out of the system, which is why, of course, they're focusing on the AML portion of this and the know your customer piece as well. My question is when this logical structure that is the blockchain gets to actually have additional capabilities or functionality, or other blockchains have this, and you've got decentralized autonomous corporations or organizations operating on a rule set that you can interact with if you want to, but isn't actually run by someone. And it makes me think back to Napster, where the Recording Industry Association of America was able to find a target and say, you're violating copyright law, you're an accessory to this, and we're going to shut you down. And they did. And then a more decentralized system arose that they couldn't shut down, so they had to actually go to the individuals. So eventually, if you are selling Beanie Babies, you are in fact a money transmitter, and there will be cases where those people are going to court for money laundering for their Beanie Babies. But it filters out the exact same way. Eventually, you have individuals interacting with something that doesn't have legal representation because it doesn't exist. It's a computer program, and it can move those things around. So there's going to be a shock to the regulators of what they can and can't actually do. They're still going to have control on the fringes because we're American citizens, at least those of us sitting here that are American citizens, and are bound by those laws. But once the value's in that system, there is no control beyond the rules that everyone agrees upon in that system.
So to touch upon the finance aspect, a lot of what we're doing right now is member services for various different people. So customers are members to us, banks are members to us, credit unions, clearinghouses, merchants, payment gateways, etc. So we have an actual platform that allows members to take advantage of other member services, real-time, transparently, zero counterparty risk. Like I said, a value engine, so to speak. As far as finance is concerned, though, and no one from Ripple's here? Okay. But again, finance is meant to be very, very simple. And everything that we know to date is presented to be so complicated so that we don't ask questions. Well, I'm sorry, but I ask a lot of questions, and finance is presented to be so complicated, but when you strip away all the scar tissue, you realize that at its core, it's just about moving a ledger. So when you can understand that you can start from the ledger and then build out all the services and aspects of the business, you realize that there's a hell of a lot you can do with the legacy businesses and consumers out there to where, yes, you're leveraging blockchain, but they don't need to know that. They just need to know that they are safe, secure, and what they know is what they know, and they're able to do that for a lot cheaper and more instantaneously. As far as the blockchain aspects are concerned, though, again, there's going to be a lot of things to explore with the blockchain and the digital asset creations and all that. We don't really get into the whole aspects of complicating things on that level. I mean, if there are going to be organizations and industries that want to run their own blockchains as we see it, then that's something that they'll do. But as far as being able to just plug and play and enter this, this ecosystem, that's something that we're providing on a very, very low level, easy to understand basis.
As far as regulation is concerned, the product that we're working on building at Overstock.com, which is, again, a kind of an alternate stock exchange, where, of course, this thing's going to be regulated by the SEC. There are a lot of people that are running around, either, they're building new, Bitcoin 2.0 applications, and they revel in making the point of how different they are. Our main goal is to convince the SEC how different we're not. And in other words, when we build this thing and when people use it, they won't really be aware of the plumbing of what's happening behind the scenes. That's the idea, is to convince the SEC there's no reason why there needs to be new rulemaking or anything related to this. This is no different than really, as far as users are concerned, from what they were accustomed to. The only difference is it happens much more quickly and for much less money. So I think that's something that we should consider as we move forward, building these Bitcoin 2.0 technologies, is quit going off on how different they are, but instead point out how similar they are to what's already happening, just with the added advantage of less cost, less friction, greater protection.
Elise, I was wondering if you could give us a perspective, a venture capital perspective, really of what you're seeing in the marketplace from a startup perspective, and especially what is different about blockchain companies, whether it's more complex or easier or the same as you see in innovations and other technologies.
Sure. So certainly regulation is more complex and definitely has to be given more time and attention, and a deeper attention to for Bitcoin and blockchain companies than other startups. And really where we're interested in seeing a startup go is that they understand how use of capital will be impacted, or how capital reserves will be impacted by what they need to spend on regulatory compliance. So what that means is when you come to present in front of an investor, you understand that you're facing $500K in regulatory compliance, and you understand how that will affect your runway and development. And so as long as a company's been thoughtful, it's not a deterrent, but it's not an insurmountable deterrent. But it's important that your team has the ability to respond to regulatory constraint.
Are you more bullish on international investment, say in the UK, given kind of London mayor's position that he's so pro-blockchain versus what you're seeing in the U.S.? Do you have any thoughts on that?
Right. So certainly I think that there's geographies or cities or states or countries that can win by the regulations they put in place for Bitcoin and blockchain companies. And I think it's really exciting actually to see that perhaps this innovation doesn't have to be led by Silicon Valley, and and perhaps it will be if the U.S. can catch up to it. But perhaps leadership takes place in Singapore, or perhaps it takes place in London or somewhere else where government is quicker to respond, and perhaps quicker to respond because they're hungrier to have innovation happen there and to capture the value from that.
Yeah, so the UK, just for everybody to know, and I've been working on the UK Technology Board for a few years and kind of helping them HMRC, which is our tax office, and everything else, Bank of England, and literally they're doing something different than everybody or every other government in the world. They're actually putting their money where their mouth is, and they're actually investing into research, and they are building out a framework that will support this entire space because, and it's not just crypto. Just to highlight, this is financial technology, this is fintech, and it encompasses a lot of different moving parts, and they've said, you know what? No one's doing this right, and there will never be another sector that we can own ourselves, and we're going all in, and they have. And you'll see some very, very exciting things in the UK specifically, which then allows companies to passport all of those services across all of Europe and eventually to other markets as well. So yes, that's the little difference between the UK versus a very segregated and broken market like the US.
I love what Judd was saying a moment ago about showing the regulators that what is being developed has parallels to the current world and the real world. The reason why that is beneficial is because it's a language that regulators themselves do understand. I think the counter, not necessarily the counter to that, but another parallel to that is the kinds of things that are being developed right now don't necessarily fit into categories that they already do understand. And it is now imperative upon us to make sure we communicate that new language, that new nomenclature to the regulators to let them know where are the boundaries of things that are and are not possible. Regulators previously, before we had anything decentralized and autonomous, had, in essence, complete control under the law. Now they don't actually have some portion of that under their control at all. And if they don't understand the boundary, they're actually going to impose more burdensome regulations that aren't even practical to follow, if not impossible to follow, without realizing that that's what they're asking. The motivations are, of course, positive. You want to have consumer protection. You want to make sure that ISIS can't fund things, et cetera, right? So everyone in here agrees with those general principles. The disagreement is, in fact, of what is and is not possible. And the impetus is now on us to communicate that language to the regulators to let them know we're on board, we're willing to help. You need to understand what you're looking at.
The BitGive Foundation is a nonprofit charitable giving organization leveraging the power of the Bitcoin community to improve public health and the environment worldwide. Help us demonstrate the significant impact of Bitcoin in addressing these critical issues on a global scale. Support international giving in Bitcoin. Please visit our website at www.bitgivefoundation.org. That's www.bitgivefoundation.org.
Today's magic word is debate. D-E-B-A-T-E. Use the magic word and claim your share of this week's listener reward of LTB coin on letstalkbitcoin.com.
Maybe we can switch gears and talk a little bit about cybersecurity. One of the pros that we hear of the decentralized blockchain is that it's less susceptible to a direct denial of service attack because there's no central point to attack. But Kaspersky Labs just came out with a article discussing the ability to create a exploit code and open a notepad basically to upload code to the blockchain that's going to get replicated, and it would be a way to basically attack the blockchain with useless information. Anybody have thoughts about the risks even of a decentralized blockchain?
Well, we spoke just before this panel about that actual topic, and it harkens back for me to the debate of Bitcoin versus blockchain. And my only argument for that discussion was the Bitcoin blockchain itself, speaking of the Bitcoin blockchain in particular, uses Bitcoins as a unit of value. But blockchain as a concept has a lot of different balancing elements to it. You've got miners doing one piece. You've got nodes doing something else. You've got rule sets that are being followed by others, et cetera. And I just lost my train of thought there for a second. In essence, you've got a balancing mechanism that if you were to create this random data to cloud a decentralized blockchain, because of the value token that exists, and in the Bitcoin blockchain's case, it is in fact Bitcoin, there's a cost to you for causing a problem. That is actually, for me, the necessity of a value token that goes along with a blockchain. So when we're talking about being able to exploit a blockchain in general, not if it has a value token, or at least it's much harder with a value token.
Judd, so I wanted to give you a quick plug and really hear about the use cases of the blockchain. Can you talk about Project Medici?
Of course. Overstock's an interesting company by virtue of the fact that we have a kind of an interesting CEO who sort of likes to take on challenges and promote justice in the world. And one of the things as a public company, we came to the realization that it was possible in the public equity markets, in the stock market, that bad actors had figured out, they figured out several things. I mean, one of these things is high frequency. It's not the high frequency trading itself. It's the capacity to get out in front of the orders of the rest of us that's a problem. So there's that. There's the capacity to essentially trade a share more than once, in fact, many, many, many times, which artificially inflates the volume of trading, and it has a depressive effect on a company's stock, so there's capacity to manipulate. And it was interesting at one point, after we started accepting Bitcoin, and the Reddit community wanted us to do an Ask Me Anything session, and somebody said, why don't why don't you guys create an alternate stock market based on this stuff? And there was just this total light bulb moment at the same time. We looked at each other and said, why don't we do that? And so that became something very quickly was in the works. And it works. It's not going to be too long before you're going to see this, thanks in large part to the fine people at Perkins Coie, who are providing us legal counsel. Well done. But we've actually done this. Currently, in the status quo, when you trade stock for, money, you don't actually get access to that money for 3 days. There are all these intermediate steps that have to happen before you can actually settle these trades. We've worked this thing out, and it works. Where when you make a share into a digital token, and you trade it for USD coin, as we're calling it, it happens in about 5 seconds. And it is as secure as anything that's out there now. So this is really exciting and something we think will provide an alternate mode of trading, not only for existing public companies, but also for companies that would like to access the public equity markets but can't quite get there because it's so expensive to go public, and because there's so many kind of predatory traders that want to take advantage of them and prey upon those. So this way we avoid all those problems. So anyway, very exciting, and be looking for it. We call it Medici because after the Medici Bank of Florence, they pioneered the dual entry accounting system and became very rich, and that sparked the Renaissance, and that was kind of a big deal. And there have been no innovations to bookkeeping until 2008. So we named it this after them, in response.
Eric, do you want to give a quick use case on BitReserve?
Sure. I think earlier it was mentioned about remittance. I personally don't see Bitcoin playing into remittance at all unless we stabilize the actual value or what happened. I knew that was going to happen. Did I tell you? I told you. All right, I'll stand and talk. Much better. Remittance is not actually going to function on Bitcoin. And I'm just going to flat out tell you right now. You're not going to be giving a colony in Africa or Southeast Asia Bitcoin. You're not going to be giving merchants or industries or supply chain management Bitcoin. What needs to happen is you're going to actually have to give them what they know and what they're most comfortable with. What they know and what they're most comfortable with is dollar, yen, pounds, euros, pesos, rupees, right? So how do you do that then in a free, instant, transparent manner? And that's what we provide. So again, with the remittance aspect, we actually partnered up with Banca Azteca, which is all public knowledge. So Banca Azteca is one of our largest investors with the Salinas group of companies. And we've actually just finished the integration into all the POS terminals for Electra. Electra is the actual supermarket chain, it's kind of like the Walmart of Mexico, if you're familiar yet. So what's going to happen when we launch our entire fiat channels, right? Now I'm talking about every funding method possible. We're a value engine, so no matter what the value is, you put it in. So if it's credit, debit, ACH, SEPA, SOFORT, China Union Pay, Discover, Amex, etc., you're going to be able to load that value. iTunes card, Amazon prepaid gift cards, etc., loyalty, rewards. Pipe it in. Build your financial profile. Now I'm going to fund my ACH. I'm Juan. Pretend I'm Juan, okay? I'm Juan, and I'm funding my actual Bit USD with ACH. Bit, by the way, is digital. If you didn't know, Bit actually means digital.
Eric, you got 30 seconds.
And I'm going to now be able to send Bit pesos for free to Maria in Mexico, and she's going to be able to go to any Electra, not using Visa or MasterCard rails, and pull cash out from any till without actually paying any fees or interchange.
So it sounds like you're disrupting the traditional payments rails.
That's the first use case for the remittance channel between U.S. and Mexico that we're after, yes.
Craig?
This is blockchain use cases and how Tether applies.
You've got an altcoin, right?
It is not an altcoin. It is at best a meta coin that exists on top of the Bitcoin blockchain. In essence, when we're talking about building blockchain technologies, I think it was February of 2011, a gentleman named J.R. Willett put a white paper out that said we can actually add metadata to Bitcoin transactions. And that project was invested in by the community and built into a platform now called Omni, which does allow, in fact, asset issuance and metadata to be used on the Bitcoin blockchain for transactional purposes. Tether is leveraging that platform to be able to issue real-world currencies on the Bitcoin blockchain. So if you have any real-world currency, dollars, euros, yen, yuan, pesos, etc., and you want to be able to leverage all of the strengths of the Bitcoin blockchain, but yet retain all of the benefits of your local currency, you now have the option and ability to do so using the Tether platform. So that is our use case of additional blockchain technology benefiting the end user.
Elise, now that you've seen kind of the transformation from Bitcoin 1.0 to blockchain 2.0, tell me about what you're seeing in terms of trends, maybe lessons learned from a VC perspective and where you think we're going. And the last piece of that is, how much is Bitcoin going to be worth in 5 years?
Can I go to an audience support for that? Like a phone a friend? We should ask Jeff that question probably.
I'd love to hear that from Jeff.
Jeff will do hand signals so I can. Okay.
I can bring you the microphone.
So I think so Jeff will answer for me later, and I agree with what he says on what the price of Bitcoin will be. I'll say that. So what we're interested in is, and Nick Sullivan referenced this earlier on his panel on adoption, is really, I think that, so there's two things. So we're interested in companies that adhere to the core value of the technology. So meaning companies that want to see a decentralized and distributed network of power or access to resource. So we look for that. And then as Nick referenced, we look for companies that are, and what I think is most important to the ecosystem and able to gain value quickest are companies that drive adoption, and not adoption of the folks that are like the hardcore crypto anarchists who are, those are my favorite people, but there's not enough of them. To create value for the company or value for the ecosystem. So we're looking for folks that are thinking, what does Bitcoin mean to the high schoolers? What does Bitcoin mean to people in Peru or Argentina? And what does it mean to my dad or my mom? And are creating products around that.
Yeah, I mean, that's great. I mean, that's the way that we're going to drive consumer adoption, period, is by giving them the ability to look at something that they already know. I love the fact these Bitcoiners and these crypto anarchists are like, we're going to replace the dollar, we're going to replace the pound. No, you're not.
Well, they can both happen too.
Right? I mean, yeah. Well,
I want to add a corollary.
When you if you want to replace the dollar, you're going to strip away the identity of people, and they don't like that.
So what we're hearing, statistics up there that says that 50% of millennials think that they won't use banks, or banks won't be around in 5 years. And then the question I have for anyone in this room, besides your speculation dollars, would you want your money not FDIC insured? And so this is kind of, my advice for startups would be avoid the US, go to the UK, where you're going to have a risk-based system without kind of the hurdles of the state-by-state system, and that's what's that's what's happening now. I mean, Australia came out with an opinion that peer-to-peer transmission is not money transmission, so they're not going to regulate it.
And they charge high taxes.
So the rest of the panel, I want to know. So we're talking about blockchain. But Bitcoin, does anybody think, what's the price of Bitcoin in 5 years? You can say 0, you could say whatever you want, 1,000. Go ahead, Greg.
Higher than it is currently.
Okay.
$350.
I'm completely agnostic. I haven't put a second of thought into it. I don't care. So
really, yeah,
it's funny.
I don't really care.
The folks that are building things on top of blockchains have a perspective of that the value of Bitcoin from that perspective doesn't actually have a factor in it. However, those of us who are also Bitcoin holders want the value to go up, and of course, with increased adoption, it should.
So let's save some time for questions from the audience. Ask us something hard. Ask us something controversial. We like all that. Yes, sir.
I want to know what you guys' definitions are of blockchain 2.0. Is it like a specific purpose? Do you have definitions of blockchain 3.0 also?
I'll start with the Satoshi paper that basically said it was a peer-to-peer currency, like a payment system, basically. That to me is blockchain 1.0. And then when you start transferring ownership or instructions, to Craig's point, executing instructions, that's probably 3.0. Maybe, but 2.0 would be units of ownership, in my opinion, units of ownership that don't necessarily mean just the peer-to-peer system. Anybody else?
So moving on to blockchain 10.0, you really, now you have the ability where you don't even need to see the guts. Like, we're still looking and dealing with guts. We don't even have this HTTP or TCP/IP play with the protocol itself. And right now everything is so fragmented and confusing that nobody really knows where to go or what to do, and no developer knows what project to kind of start with, and it's a bit problematic. Now, blockchain 10.0 is completely clean, completely API-driven, beautiful interface, and completely plug and play.
Can I throw something in? I think, a lot of people probably came here to talk about Bitcoin as an investment and things like that, and they may not find this stuff too interesting, but let me say that when we talk about how to encourage the adoption of the widespread adoption of Bitcoin, and I think kind of a proxy, like an easy way to think of that is, how do we get our parents to use it? Okay, and I believe that Bitcoin 2.0, which these are currency transactions, this is the key to the adoption of Bitcoin 1.0. So in other words, if you can, for example, if I can get my parents to feel comfortable with the idea of like property title transfer via the blockchain, that doesn't seem too risky. Okay, if they can get comfortable with that, then all of a sudden they'll get very comfortable with the idea of exchanging currency this way. So the success of Bitcoin 2.0, I think, is vital to the ultimate success of Bitcoin 1.0.
Yes, sir.
First, an excellent panel, but you guys are all so smart. It's amazing. A couple quick questions.
This is our favorite audience member, by the way, now.
Two questions. One, is BitReserve and Tether, are you guys kind of competitors? And the second question, and you guys don't have to answer this all, how come you think, Judd, you guys went down the road with Counterparty and then made the reverse? What changed in your thinking?
I'll start, and then and we were actually, this is a really good question, actually, because it's important to highlight that Tether is very focused on the digital asset and transfer of value between that, whereas we're completely focused on actual membership, consumers, banking partnerships, legacy financial services, credit unions, all those different aspects, whereas Tether is actually quite complementary, really, to our platform. So I think we'll explore that later. But besides that, it's important to highlight, because it might seem as if they're digitizing dollars or digitizing pounds. We're building a reserve bank, so a digital reserve, BitReserve, and we're actually holding all those real assets in our holdings, and then being able to give the advantages and services to the different members we have within our ecosystem, who are, again, we're fully accountable for them. I don't think Tether wants to deal with customers at the end of the day. They're just providing the service. So I think that's something that is important to highlight.
Tether has one primary job, and that is making sure that the value of the token matches the underlying assets that back it. So if you come to Tether with a Tether US token, you will get $1 in exchange, hands down, end of the story. Who is the person giving them out or using them in merchant services, et cetera, is basically not a focus of Tether. It's making sure that these things are in circulation. And so they are, in fact, complementary pieces. I mean, I can imagine a BitReserve version coming soon where if you wanted to move your BitUSD off of that platform and onto the blockchain, you would use, in fact, Tethers to do so.
That's a real simple one, actually. That's great.
So just to give a little bit of background, one of the really interesting Bitcoin 2.0 companies is called Counterparty. They've created a platform for the exchange of digital assets. So anybody could go and create some token and then trade it on Counterparty. So we initially decided to build MetaCheap on top of Counterparty, which in turn is a layer on top of the blockchain. What we discovered before too long was that it was apparent we were going to quickly bump into technological constraints. If we're going to build a stock market that's really going to function and be liquid, you have to do more than 7 transactions per second. So that became apparent, and they're now working out a way to increase that to like 7,000 or something. But that's still just scratching the surface. So that was so they then decided we realized we viewed the world differently. They decided they were going to build their own thing, and so they went and did that, and we're still friends and not going to be competitors. So that's the reason. It was just that we needed more than what they could provide.
Can I just ask, how do you think you missed those limitations going in?
You know, this is such a new thing, we didn't even know the right questions to ask, frankly. And so it took a while to figure those things out. So I think we're kind of blazing a trail for others who will follow us, and we're trying to build Medici to be agnostic in such a way that we'll be able, so we hope they have success, because the thing we're going to build will be able to interface with them and with, Ripple and Ethereum and Next and all the others. We hope everybody succeeds, because we're going to, rising tide lifts all boats, yada, yada, yada.
Last question,
yeah.
Dan.
This is for BitReserve. When are you gonna digitize oil?
Yeah, so we expect the Bit Oil, which we did announce, we expect the Bit Oil probably to come, I would think, by June or July. And that's a really good point. And just so you know, Bit as in digital, so we have Bit USD, Bit GBP, Bit Oil, Bit Gold, Bit whatever, right? So that Bit Oil use case is quite astounding, because now you have a whole bunch of markets that can actually be using their oil reserves and actually using that as a value and spending against their oil reserves, as opposed to actually going through the legacy financial ecosystem, so circumventing it using actual just oil holdings.
So I want to thank my panel. I hope you found this valuable. Just give one quick thought, since it's the cocktail hour, as a segue to the next speech, about the fact that with Bitcoin or blockchain using financial instruments, it basically allows artificial intelligence or autonomous agents to have access to money, so they can order human developers to continue to develop themselves, machine learning, and Skynet versus evolution. Take it away. Thank you.
Thanks for listening to episode 22 of the Bitcoin Game. There's a lot of compelling Bitcoin content out there, so I truly appreciate that you took the time to listen to this podcast. As much as Bitcoin may be subjugated by Craig from Tether and Eric from BitReserve, keep in mind that both their platforms right atop the Bitcoin blockchain, so perhaps they have more faith in the oldest cryptocurrency than they let on in this discussion. I hope you'll talk to me on Twitter. I'm the BTC Game. You'll find a listing of all the Bitcoin Game episodes by going to thebitcoingame.com. And please visit this episode's show notes page and tell me what you thought of this episode. See you next time.